Hey guys, so in this video, I'm going over my top 7 stocks for the month of October 2021. In the last month, I've looked through hundreds of different companies, and this is my list of stocks I think are the best buys right now. I encourage you to watch all the way through to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow. Let's get started. All right, so the first stock on my list is Tesla, stock ticker TSLA. This is an American electric vehicle manufacturer and clean energy company, and it's really been a while since I've talked about Tesla, but it's been on my radar for good reason. Right now, Tesla is trading at $781.31 with a 52-week low of $379.11 and a 52-week high of $900.40. If we take a look at the 1-year price chart, we can see that Tesla really shot at the end of 2020, hitting a peak in January and February of 2021 and bouncing back down to under $600 per share. Ever since June of 2021, it's been slowly going back up in price. Now, Tesla has a market cap of $782.693 billion, a P ratio of 411.87, which does mean that it can be quite overvalued, and earnings per share of $1.90. Looking at their valuation measures, we can see that they have a 5-year expected PEG ratio of 2.35 and a price to book ratio of 30.67. The profit margin is currently sitting at 5.21%, and they have a pretty good return equity of 12.27%. Their last 12 months revenues sit at $41.86 billion. They have total cash of about $16.23 billion, and they have a good current ratio of 1.51. It's always interesting to see what analysts have to say, so on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are currently rating Tesla as a 2.6, meaning it is between a buy and a hold. And the average analyst price target is $699.87, which is actually over 10% lower than the current price of $781.31. After a rocky start to the year like you guys saw, we've seen Tesla bouncing back towards its all-time highs. The company is still dealing with the consequences of the pandemic, especially with the global semiconductor chip shortage that resulted from skyrocketing demand for electronic remote devices. This obstacle definitely slowed Tesla's timeline and hindered its growth. On top of that, the company still has not completely globalized the production of Tesla vehicles, with China's regulatory challenges making it especially difficult for Tesla to comfortably execute its business in one of the largest markets in the world. But I'm still quite bullish on Tesla because they've addressed and solved each of these problems and have proven that they can navigate through these hard economic circumstances. The company has been collaborating with suppliers to source alternative chips that can be used for production for the past few months, and Elon Musk insists that this chip shortage is a problem that will go away very soon. The company also appears very confident that their business can still thrive during this crisis, and that's a really important thing about any great business, being how well can they thrive in a harsh economy. China's regulatory challenges and the chip shortage have not stopped Tesla Shanghai, which is Tesla's gigafactory in China, from producing 300,000 cars from January to September of this year. And Tesla is still trying to build more gigafactories, the most exciting one being in Germany. Giga Berlin Brandenburg, still under construction, will be the biggest leap forward for Tesla because it will allow the company to access the Western European market, another really wealthy market for business. Now, Tesla will talk more and more about its developments and news in its upcoming annual meeting on October 7th at 2:30 p.m. PST. Shareholders can access the meeting virtually through the company's website. So, considering the list of successes on Tesla's resume, I personally do believe that Tesla will continue to grow far into the future. The EV movement is nowhere near as massive as it is slated to be in the future, and the face of this growing industry will, I believe, be Tesla. That's why I'll be adding more of it to my portfolio as a long-term hold. All right, second on my list is Adobe, stock ticker ADBE. This is an American multinational computer software company, a company that I personally use every single day with Photoshop, Lightroom, and Premiere Pro. Right now, one share of Adobe is trading at $577.70 with a 52-week low of $420.78 and a 52-week high of $673.88. You can see that over the last year, Adobe stock has performed extremely well, hitting highs of over $650 a share. But since then, they have dropped dramatically, which means that it could be a good time to start picking some up. Adobe has a market cap of $275.216 billion, a P ratio of 47.75, and earnings per share of $12.10. They have a 5-year expected PEG ratio of 2.45 and a current price to book ratio of 22.51. They're very good profit-wise with a profit margin of 38.67%, and they also have an extremely strong return equity of 44.7%. They're sitting on about $6.16 billion of total cash, and they also have a good current ratio of 1.39. Analysts do love Adobe, and they're rating it as a 1.8, meaning it is a buy, and the average analyst price target is $703.92, which is almost 20% higher than the current price of $577.70. So yeah, like I mentioned, Adobe stock has increased significantly since the last time I mentioned it, but we did see a very big pullback recently, meaning that it could be a good time to buy again. Prices could continue going down in the short term, but I think that any time is a good time to buy Adobe shares for the long term. Now, recently, Adobe announced that it achieved a record revenue of $3.94 billion in its third quarter of fiscal year 2021, which represented a 22% year-over-year growth. You expect the growth of the company to slow down, especially after the pandemic when demand for electronics and software was at an all-time high, but the fact that Adobe continues to majorly deliver in profits shows how solid of a company it is. The company also announced its $1 billion acquisition of Frame.io, a software platform that allows video editors and producers to easily collaborate through its cloud-first workflow. This acquisition enables Adobe to solidify its position in the cloud computing market while also enhancing its video production catalog. The collaboration with Frame.io will also open Adobe's products to a larger audience. And such a hefty purchase shows how much money Adobe has at its disposal to reinvest in itself. Oh, and I also use Frame.io, and it's an amazing platform. So yeah, that's also why I really like this acquisition. The largest segments of the company's business generated handsome profits during Q3 of fiscal year 2021, with digital media achieving $2.87 billion in revenue, a 23% year-over-year growth. And Adobe's Experience Cloud generated over $900 million in revenue as well. These profits indicate that Adobe's digital software products, including their Creative Cloud, are still popular and in high demand. This consumer market includes users of Photoshop, Premiere Pro, After Effects, Lightroom, and so many more platforms that are becoming more important in our increasingly digital lives. And we also have Adobe's Experience Cloud, which is a software platform that helps with marketing and web analytics. So yeah, Adobe has clearly shown that it has a solid foothold in several digital markets, and with its proven longevity, its massive pool of wealth, and its continuing growth, this company is not going anywhere anytime soon. I'm bullish on the long-term growth of Adobe and will continue to invest in this company. Before we talk about my next stock pick, I want to introduce a new stock trading platform called Moomoo, who is the sponsor of this video. You're going to love this because they're giving out tons of free stock to you guys when you use my link below. More details later. Anyways, Moomoo is a very reputable trading platform that's new to the US, but is actually the #1 trading app in Hong Kong. Its parent company, FUTU, is celebrating its 9th anniversary this year as well. I really like Moomoo because they offer free pro-level data and tools that really help with trading, as well as the ability to monitor and compare stocks using their AI tools. Moomoo does not make money from payment for order flow, unlike most other brokerages out there, meaning that you're always getting the best price on your buy and sell orders. Now, like I mentioned, Moomoo is an advanced trading app. Their UI does take time to get used to, but it's designed for serious traders who are looking to learn and grow using their tools, as well as make the most amount of money possible. If you are looking for a stock brokerage that allows you to trade like a pro, definitely consider opening an account with Moomoo. I personally have found their tools to be very helpful in my own trading. And like I mentioned at the start, Moomoo is actually giving my viewers a very special deal. For a limited time, you'll receive a free share of Lucid when you open up an account and deposit $100 or more. That's way higher than any other brokerage, and I'm all about giving my viewers some free stocks. So yeah, I'll put the link below, and I just really highly recommend checking them out and claiming your free stock today. And now back to the video. All right, next up on our list is BJ's Wholesale, stock ticker BJ. This is an American membership-based warehouse club chain, which is comparable to Costco. So yeah, in other words, BJ's clubs, they usually carry large assortments of items ranging from electronics to produce. Right now, one share is trading at $57.43 with a 52-week low of $36.07 and a 52-week high of $59.81. Their price chart shows tremendous growth within the last year. BJ's is a relatively smaller company compared to some of the other companies on this list, with a market cap of $7.842 billion. They have a P/E ratio of 19.4 and earnings per share of $2.96. Lots of future growth is expected for BJ's, and they have a 5-year expected PEG ratio of 1.51. The price to book ratio is at 16.11. Now, when it comes to profitability, they have a current profit margin of 2.61%, which is in line with other warehouse chains. However, they have a tremendously great return on equity of 135.44%. They're sitting on about $42.41 million in cash, and they have a current ratio of 0.7, which is one thing lacking about the stock. Analysts are currently rating BJ's Wholesale as a 2.2, meaning it is a buy, and the average analyst price target is $58.50, which is just a hair over the current price of $57.43. So for some people, BJ's is their local exclusive bulk item store where they can buy pretty much any essential thing that they need. Wholesaling clubs like this allow its customers to save a lot of money, and as a result, BJ's Wholesale has become the premier source of household items for many residents along the East Coast, with increasing membership sales in their most recent earnings report. Now, the thing that really stuck out to me the most was in their press release a month ago, when they really emphasized the growth of digitally enabled sales of 4%, and the fact that members aggressively took advantage of this option. This is really important because it shows that BJ's knows how to navigate through bad economic circumstances where people are either confined to their homes or are hesitant to do too much in-person shopping. If we take a look at the company's website, we can see that BJ's offers several options for buyers to comfortably make purchases purchases, including same-day delivery, curbside pickup, and in-app shopping. So yeah, I know it's not the most exciting company, but I really do think that BJ's Wholesale is a respectable and solid company, and it's one that you should definitely keep on your watch list. All right, number 4 on our list is Uber, stock ticker UBER. This is an American tech company that's largely known for its ride-sharing services. However, the company has extended its reach into plenty of other types of services, including food and package delivery. Right now, one share of Uber stock is trading at $44.52, with a 52-week low of $32.90 and a 52-week high of $64.05. Over the last year, we can see that in November of last year, their price shot dramatically, stayed relatively high for about half a year, and since then it's really dropped down in its price. Uber has a market cap of $83.891 billion and earnings per share of negative 57 cents. They currently have a price to book ratio of 5.28, profit margin of negative 7.97%, and a return on equity of negative 8.22%. They're sitting on about $5 billion in cash, and they have a current ratio of 1.01. Overall, analysts do like Uber, and they're rating it as a 1.8, meaning it is a buy, and the average analyst price target is $67.33, which is about 50% higher than the current price of $44.52. In their most recent earnings report back in early August, Uber reported an astounding 114% year-over-year growth in gross bookings. In other words, the amount of money that consumers spent on Uber's large catalog of services, from ride-sharing to deliveries, more than doubled within one single year. That's a pretty ridiculous growth rate, and Uber even emphasized in their supplemental presentation that the growth took place during a Delta variant-related slowdown in the economy. This is pretty reassuring news to any investor to know that a company can still, at best, maintain profitability during an economic crisis. Now, one of the biggest long-term strengths of the company is its versatility. I already mentioned its familiar ride-sharing and delivery services, but the company also provides freight transportation, delivery services, and through its partnership with the company Lime, electric bike and scooter rentals. Uber Freight recently partnered with Blue Grace Logistics to take advantage of the company's Blue Ship technology, which will assist with Uber Freight's less than truckload, aka LTL services. I will say though that there is a lot riding on Uber's profitability being tied to the future of autonomous vehicles, because as you saw, they're still not yet profitable. And yeah, their ultimate plan of course is to eventually get rid of drivers and instead rely solely on these self-driving cars that riders can book using their phones. That plan was put on hold when they sold their autonomous vehicle business to Aurora Innovations so they could focus on building profits instead for now. Yeah, overall, Uber is one of the most popular businesses in the world. We've all heard of it, we've all used it, and I do think that the company's stock is solid, pending a few quirks here and there. So yeah, overall, still a great long-term pick in my opinion, and one that you should consider having on your watch list. All right, the next stock we're talking about is Morgan Stanley, stock ticker MS. This is an American multinational investment bank and financial services company that executes financial transactions and exchanges for large institutional clients. They deal with investments in stocks, ETFs, as well as other financial instruments. Right now, one share of Morgan Stanley is trading at $99.55, with a 52-week low of $46.42 and a 52-week high of $105.95. Their one-year price chart shows almost linear growth. They have a market cap of $181.635 billion, a P/E ratio of 13.2, earnings per share of $7.54, and they pay a mild dividend of 2.66%. They have a 5-year expected PEG ratio of 6.41 and a price to book ratio of 1.82. Their current profit margin is 24.86%, and they have a good return on equity of 14.11%. They're sitting on about $562.29 billion in cash, and they also have a great current ratio of 1.88. One thing I really like about Morgan Stanley is that they seem to take risks. Specifically, the company doubled down on its Bitcoin exposure through grayscale shares, showing that Morgan Stanley is not only ambitious with its financial ventures, but also willing to stay up to date with today's financial opportunities. Now, interestingly, Oppenheimer very recently downgraded Morgan Stanley's valuation, with the investment bank's opinion on Morgan Stanley being that the upside was less than expected. However, their analysis didn't really mention too much about how Morgan Stanley would reinvest in its own growth, but instead seemed to emphasize the idea that banks would always be lucrative, but will never be exciting. Morgan Stanley's business model is all about investing and making money, and with their continued growth, with an 8% year-over-year growth in total revenue from 2020 to 2021 based on their most recent earnings report, Morgan Stanley proves that it's a strong company to invest in. Now, looking forward, the company is expected to report earnings on Thursday, October 14th. So yeah, definitely be on the lookout for that. But overall, I think Morgan Stanley is a relatively safer, mild dividend long-term hold that's currently near fair value. It certainly has the potential to take a dip in the short term, but over the next decade, it should perform quite well in my opinion. All right, number 6 on our list is Airbnb, stock ticker ABNB. This is an American online lodging marketplace which allows users to rent other people's homes for vacation stays on their platform. They're currently trading at $168.07 per share, with a 52-week low of $121.50 and a 52-week high of $219.94. After their IPO, we saw the price of Airbnb Airbnb shoot up dramatically and then return back to IPO levels. Since May of 2021, Airbnb has trended upwards. The current market cap is $105.656 billion, and they're not yet profitable with an earnings per share of negative $10.76. The current price to book ratio is 29.95. They're obviously not profitable yet with a profit margin of negative 110.97% and yearly revenues of about $4.42 billion. They're sitting on $7.43 billion in cash, and they have a good current ratio of 1.48. Right now, analysts are rating Airbnb as a 2.4, meaning it is between a buy and a hold, and the average analyst price target is $175.76, which is a little bit higher than the current price of $168.07. So in my opinion, it does make sense for Airbnb stock to increase in value, considering that people are itching to travel more and book rental homes after facing travel restrictions for the past year and a half. As you guys can see, travel numbers and expectations have increased substantially since earlier this year. A really massive advantage that Airbnb holds over normal hotel companies is that Airbnb can allow travelers to access more remote locations where hotel companies might not have access to. It's easier for travelers to be accommodated in more suburban or even rural areas because Airbnb itself is a decentralized travel platform that owns none of the homes that are on its platform. Now, I personally see this as a long-term strength and indication of durability. In its most recent earnings call last month, Airbnb announced that 83.1 million nights and experiences were booked with the company in Q2 2021, which is an absolutely insane 197% year-over-year growth. In other words, the amount of nights and experiences booked with Airbnb tripled within one single year, going all the way back to pre-COVID levels. I really love it when I see companies that are able to maintain their durability during hard times, and Airbnb's financials suggest that the company is fully capable of recovering to its full form before the pandemic. Beyond that, in terms of revenue, the company has not only returned to pre-COVID levels, but has completely exceeded pre-COVID levels by 10%. Overall, I'm a really big fan of this company. I personally use them. You guys probably have used Airbnb as well. And looking through the financials as well as the business model, I really do think that Airbnb is one of those companies that you should try to invest in at some point. That's why I'll be adding it to my portfolio this month. All right, number 7 on our list is Apple, stock ticker AAPL. This is an American technology company that's most known for designing its iconic smartphones, tablets, computers, laptops, and operating systems. So right now, one share of Apple is trading at $142.83, with a 52-week low of $107.32 and a 52-week high of $157.26. In the last year, we've definitely seen an overall trend going up for Apple's share price. They're an absolutely gigantic company with a market cap of $2.361 trillion. They have a PE ratio of 27.96, an earnings per share of $5.11, and a very small dividend of 0.62%. We expect to see lots of growth from Apple, and they have a 5-year expected PEG ratio of 2.0 and a current price to book ratio of 37.56. Their profit margin is at 25%. They have a return on equity of 127.13%, which is absolutely very strong. And looking at their balance sheet, we can see that they have total cash of $61.7 billion and a current ratio of 1.06. Analysts really do like Apple, and they're rating it as a 1.9, meaning it is a buy. And the average analyst price target is $167.92, which is about 15% higher than the current price of $142.83. Apple has really proven its durability for decades at this point, but it still faces significant challenges to this day. Recently, the EU pushed for universal USB-C phone chargers, which might hinder Apple's business because Apple's iPhones and their iPads are all charged using lightning cables. I personally don't think that this will be too big of a problem in the long run, but yeah, it is definitely something that is annoying for Apple engineers. As the company grows more and more valuable, the stakes for Apple's executives continues to inflate. A few days ago, Apple CEO Tim Cook received 255,000 shares of Apple stock as part of a compensation package. Just as it's time to panic when company executives start selling some of their shares, it's also probably a good thing when company executives start receiving or buying shares. Apple recently unveiled new features of the productivity apps that are part of their iWork suite, showcasing the company's diversification into work-related products. And more excitingly, the company's new iPhone 13 and iPad models arrived globally just last week, with the new iPhone 13 model getting investors particularly excited due to its upgraded battery and insane camera capabilities. So yeah, I just picked up my iPhone 13 Pro, and it's definitely one of the best phones I've ever used. Apple released its earnings on Thursday, November 4th, and I'm really excited to see what the numbers are because the company's newest releases will certainly have a strong impact on its financials. Apple has been and will likely continue to be one of the most reliable and durable stocks on the market, which is why I'm strongly invested into this company and will continue to add more shares. Anyways, those are my top 7 stock picks for the month of October 2021. Remember, you guys, I'm not a financial advisor, and before you invest in any stock, you must do your own due diligence. I recommend doing at least 1 hour of research for each stock that you're interested in, and simply think of this video as an analysis of 7 different stocks that I like right now. Anyways, if you want to get your free stock from Moomoo, I'll put that link in the description below. If you guys enjoyed the video, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, entrepreneurship, and investing. Anyways, thank you so much for your time, and I'll see you in the next video. Peace.